Okay. So when it comes to being a profitable trader, I would say there are three sort of levels to it, and we can almost structure it as if it was a pyramid. So we'll call this like the trading profitability pyramid. Um, and I think it will make a lot of sense to you. So the first level of the pyramid is something that is actually available to everybody. You do not need to be a super skilled trader to take advantage of this first level of the pyramid, and we're just simply going to call it the risk premium level of the pyramid. All right. So what the risk premium level of the pyramid is something equivalent to this: buying the S&P 500. Everybody can go and buy it, and if you look at it over time, it makes about 8% a year, and we understand why that's the case. You are getting compensated for holding the risk that these equities in this basket go down. The compensation for holding that risk is about 8% a year. In options, we have something similar called the variance risk premium. It's actually, you can think of the variance risk premium, which is about 11% a year, as the equity risk premium plus compensation for convexity, right? And what we mean by this is when you're holding the equity risk premium, your returns can look like this. But with the variance risk premium, it's like this, right? So if you're short this, an outsized move costs you a lot more than it does with the stock. So there's compensation for that, right? So that could be the variance risk premium in here, the equity risk premium. The reason I put these at the base of the pyramid is they are foundational. Everything else we're going to talk about, in a sense, builds off of this. And what you need to do when you're trying to do this level of the pyramid is it's about diversification. It's about not trying to get too fancy with it and just trying to get as clean of a risk premium as you possibly can. Now, the way you move to the next level of the pyramid is there's sort of two ways that you can do it. Number one is you can get really good at extracting the risk premium from the market, right? If you can find ways to reduce your variance, reduce your drawdowns without costing you the risk premium you're collecting, you can actually improve your returns. That's one way you can get to this next level. But the second way is to really take this idea of a risk premium and start running with it a bit more and say, the reason I'm getting paid, right, is for holding certain risk. Well, where in the market is there other risks that people don't want to hold? Or another form of risk that maybe the compensation for it outweighs the risks in a way that the typical buy and hold the S&P or selling puts on the S&P just simply can't provide to you. And what we call this second level, we'll call it, I'll call it this: trading as a business, okay?
Sure.
And the reason I'll call it this is there's no free money at this, when we're discussing this stuff. There's no free money in the market. You're getting paid for a reason. But similar to what we discussed before about poker, what's the most important thing if you want to be a professional poker player? You got to know your basics, but besides that, it's probably picking the right table to play at. You want to be at the table with the people who are a little loose with their money. You're not trying to sit with Daniel Negreanu and have a great game if you're trying to make money.
Of course.
Right? You want to play with the fish or the businessman who's had a few drinks and he's just waiting for a flight. These are the people you want to play against. So in the same way, there are areas of the market where somebody is simply willing to play a losing game. And there are reasons for that. Example would be earnings trading, right? I'm a pension fund. I hold a couple $1 billion in Apple shares. Apple has an earnings event coming up tomorrow. I need to hedge this position because I have a financial obligation to my shareholders. And so I'm going to go buy a put, right? And I know that I'm probably going to overpay for this put because who wants to sell these puts? Nobody. So lots of demand coming from even just me and very little supply relative to that demand. So I'm probably paying a premium, but I'm willing to pay it because what I really care about is that downside protection. So there are times where, as us coming in as volatility traders, we can find people willing to play a losing game. And there's many little areas in the market where this exists. Earnings is one. There's some stuff with like just selling short dated vol on things that have had a big change in IV that maybe can do it. Biotechs, like there's lots of areas that exist. But at this level, there's a whole new skill set that is required compared to the previous. We need a thorough understanding of volatility. We need an understanding of execution, position management, because there's a reason that these things exist. It might be commission-based, it might be slippage, so like liquidity issues, or it simply might just be that there is a lot of risk that we're holding, and we need to know how to manage our trades properly so that we don't blow up before we realize our expected value, right? We could have the biggest edge in the world, like a 70% edge. But if we go all in on the first hand,
Yeah.
we have a 30% chance of blowing up, and we never realize that reward that was there for us. That's the second level of this pyramid. And then the third level is what we'll just call, I don't have a good name for it right now, so I'll just call it the ARB.
Okay.
All right.
Mm-hmm.
This is a level that most people will never get to. And it requires a very, very strong skill set in data science, in an understanding of how markets work, in an understanding of like where inefficiencies can be found, in an understanding of how to monetize these inefficiencies. But the point of this level, the reason we have it here is, you know, the market is smart, it's very efficient, but it is not perfectly efficient. It is not perfectly balanced. And there are areas in the market where you can actually find pure arbitrages or these opportunities where the expected value is extremely high. And it's these opportunities that I think every super serious trader should strive to find, because these are the ones that take you over the top. These are the ones that like really, really separate you from everybody else. Now, what's cool about these opportunities is they are there, and they are there for retail. And the reason they're there for us as retail traders is because a lot of them have capacity constraints, meaning you can't trade $50 million in this, $100 million. Because imagine if it's like a supply balance thing.
Right.
As you start to feed more money into the supply side, the edge decreases. Right. And this is actually how markets become more efficient. So you go from the regular risk premiums to trading like a business to like the market equalizer, or like the, you know, someone actually directly contributing to the efficiency of the market. These can be things, you know, with like in crypto, there was a thing with like, you know, like exchanges not pricing things the same way. You can notice like a market maker is doing some weird stuff. You could notice, for example, on an IPO, right? Let's say when Robinhood IPO, billion retail traders came in, bought every single call option on this thing, and the implied vol on this thing was through the roof, like so high that it was impossible to sustain it. And the nice thing about these types of situations is these are not ones where they come up all the time. So this is not something that you can maybe, as the other two levels have, where you can play out your edge over a very large number of trades. This might be 3 trades a year, 5 trades a year.
Right.
Right? Maybe 10 trades a year. Who knows? But the point is, you don't have this huge diversification aspect to it. But what you do have is a really big edge. So you hit these ones hard. You obviously you have risk on the table still in a lot of these cases, but the edge in these situations is very big. And the reason you need a very, very thorough understanding and a very strong skill set to do them well is because the cost of being wrong is high.
Yeah. You're
So you
taking a
need to
big
be
shot,
an A player.
essentially. Right.
Right. And I would simply say this is like the 3 levels of profitability as a trader. And then, you know, if you're not in one of these 3 categories, I would just put this here as like bankruptcy. So I would say this is the pyramid of trading. You want to be above this line. Anywhere above this, you're in the money.
Yeah.
The higher up the pyramid you're able to get, the more money you make. And that is why this is why you learn, right? And this is why you want to learn not just like the theory and the theoretical stuff. This is why you want to become like a practitioner, right? You want to be always thinking about how to make money on it. So I'll give you like an example. When you see something weird in the market, you'll know you're moving up this pyramid when your questions go from like, oh, sell 20 delta strangle. That would be like maybe like the risk premium level. Then the next level would be you ask, who's paying me here? Why does this exist? And then the highest level would be you see something weird, and the first thing you're asking is, where's the arbitrage? This looks really weird. Is there an arb here? Right? And then it's like, okay, you know, you're at the highest level. It's like, okay, no arb here. Why does it exist? Who's paying me here? And then there's nothing. And that's like, you probably don't even do the just sell it. Unless it's like really big and you're like, okay, I'll sell it in small size, it's just a part of my portfolio. And I'd say that is the core of being a profitable trader. This would be what it would look like.